Welcome to Iraqi Dinar Update, your go-to source for the latest news, expert insights, and real-time developments on Iraq's currency, economy, and financial reforms. Whether you're a long-time investor or just curious about the dinar, you're in the right place. When undertaking any major operation, whether in finance, life, or military strategy, one must always think in terms of risk management. It is never wise to concentrate all of one's efforts, resources, or assets into a single point of vulnerability. Diversification is not just a principle of investing, it is a universal rule of survival and success. In the realm of currency exchange, particularly when dealing with complex scenarios like exchanging large amounts of foreign currency, this principle becomes even more crucial. One should never rely on a single exchange outlet, a solitary institution, or a loan method. Instead, one must adopt a strategy that mirrors the wisdom of seasoned generals. Never mass all your troops in one vulnerable position. By deciding to exchange currency across many places, rather than funneling all transactions through a single provider, you significantly reduce your exposure to several types of risk. The risk of unfavorable rates, the risk of policy changes at a single institution, the risk of fraud, the risk of operational failure, and even the geopolitical or regulatory risk that might suddenly shut down or disrupt one particular avenue. Each place you exchange, it represents a new opportunity for slightly better terms, a new relationship to build, and a redundancy that protects you if something goes wrong with one exchange or another. This approach demands more effort, more planning, and more situational awareness, but it pays off enormously in resilience and, often, in returns. Imagine if you placed all your troops on a narrow bridge, thinking it would be the fastest route across a river. If the enemy bombs that bridge or it collapses under weight, your entire army is lost at once. It is the same with currency or any other valuable asset. If you use only one place, one mechanism, one trusted path, then all it takes is one failure, one bad rate, one sudden policy shift, one unforeseen regulation, to jeopardize your entire operation. When you distribute across many places, however, the collapse of one route does not affect the others. You keep moving, you stay flexible, and you avoid catastrophic loss. This principle is not just defensive. It is also offensive in the sense that it maximizes opportunity. Different places offer different rates, different conditions, and different perks. Some might waive fees under certain circumstances, others might offer bonuses for certain transaction sizes or types. Some might have access to liquidity that others do not. By spreading out, you can selectively take advantage of these opportunities as they arise. Instead of being locked into whatever one provider offers on a given day, you gain the ability to pivot, negotiate, and seek out the most favorable deals in a dynamic marketplace. Psychologically, spreading out your exchanges across many places also trains you to think more flexibly and creatively. You begin to notice patterns, how rates move during the day, which institutions tend to react faster to market shifts, which ones offer better service during periods of volatility. You develop a richer, more nuanced understanding of the market itself, which in turn makes you a better operator. Centralizing everything into one transaction at one place does not afford you this opportunity for growth. It keeps you in a passive posture, one where you are vulnerable to being dictated to rather than engaging actively with the environment. Furthermore, when you use many places, you build a network. Each exchange is not just a transaction, it is a relationship. Over time, these relationships can lead to better deals, insider insights, and priority treatment. A single place might value your business to a degree, but when you spread yourself across multiple businesses, you create competition for your loyalty. You become a more valuable customer. Just as in any other market, competition works in your favor. You can leverage your relationships to negotiate better rates, faster service, and additional perks that would not be available to someone completely dependent on one provider. Some might argue that using multiple places is inefficient, that it consumes too much time, too much energy. But this is a short-term mindset. In any complex operation, some friction is inevitable. The key is whether that friction buys you sufficient value in return. In this case, the value is immense. The minor inconvenience of coordinating multiple transactions is nothing compared to the security, the flexibility, and the potential financial benefit you gain. It is a disciplined inconvenience, the kind that separates amateurs from professionals. Professionals accept and even embrace a certain level of operational complexity because they understand that it is the price of serious success. Another important aspect to consider is information security. By using many different places, you avoid creating a single, easily exploitable profile of your activities. In a world where data breaches, identity theft, and cybercrime are rampant, distributing your activities makes you a harder target. No single institution knows everything about you. No single breach can expose your entire operation. This diffusion of information becomes an additional layer of defense, one that is increasingly important in the modern world. Think, too, about the message you send to the institutions themselves. When you operate through many places, you signal that you are not dependent on any one of them. This forces them to compete for your business. It puts you in a position of strength. It subtly encourages better service, more favorable terms, and faster problem resolution. No institution wants to lose a customer who can easily move their business elsewhere. In contrast, if you are entirely dependent on one provider, they have little incentive to go above and beyond for you. They know you have no real alternatives. The balance of power shifts subtly but importantly in your favor when you spread out. This idea is deeply connected to broader principles of strategy, beyond even finance. In any field, those who succeed at the highest levels are those who think in terms of redundancy and optionality. They maintain multiple lines of advance. They build fallback positions. They cultivate multiple relationships, multiple sources of information, multiple paths to success. They are never trapped by the failure of a single plan, a single ally, or a single method. They move like water, flowing around obstacles, exploiting opportunities, and surviving losses that would destroy less prepared operators. In conclusion, the decision to exchange in many places rather than one is not just a technical choice. It is a strategic imperative. It reflects a deep understanding of risk, opportunity, and human nature. It embodies a commitment to resilience, flexibility, and long-term success. It is the mindset of a seasoned operator, a true strategist, a professional who understands that in any serious endeavor, the landscape is always shifting, the enemy is always adapting. Thanks for tuning in to Iraqi Dinar Update. If you found this content helpful, be sure to like, subscribe, and hit the notification bell so you never miss a beat on Iraq's evolving financial landscape. Stay informed and stay ready.